Thursday episode. We've got Matt back. He's got a brand new baby in the house, so maybe we'll hear a little baby activity later. Who knows? We're just waiting for Paul to get through the tech stuff and join us. So we'll just kind of wrap a little bit while we wait for him to pop in.
Yeah, absolutely. So I am officially co-parent of a second child as of last week. Wednesday night, I was actually at a happy hour. It was like my last hurrah. Actually, with my group of students, we were at Marge's Lakeside, and my wife was calling me, and I'm the worst. Like I sidebarred her the first time, then she called me a second time, and then she said, "Matt, I feel weird. Come home." And I was like, "Oh no!" So we were supposed to have this baby like later this week or next week. So yeah, I mean, about an hour and a half later, we had a baby in our arms. So it was pretty.
Awesome.
It was pretty wild.
Yeah. So congratulations. Looks like Paul made it into the green room. So we're going to bring Paul on. He's a real estate heavyweight, business magnate, and transformation coach with over 800 units in his real estate portfolio. Paul knows the ins and outs of successful investing. So here we go. Bring Paul in.
What's up,
hey,
fellas?
Paul, how are you?
Doing good.
Oh, yeah. Thank you so much for coming on the show.
Yeah, you're welcome. You're welcome.
Yeah. So we usually just get started with you giving a little bit of background on, your experience with real estate, specifically kind of how you got into it and what led up to where you are now.
All right. Big question. I've been in the real estate business all of my life.
Okay.
So I bought my first property when I was 17 years old. I bought a raw piece of dirt. I was going to build a house on it. I was going to sell the house. 2 years later, I had no idea how to build a house. So I sold the dirt and I doubled my money. I bought the property for $7,500. I sold it for $15,000. I bought that property for money that I'd accumulated mowing lawns and raking leaves and doing the things that young men do in the neighborhood. And then 2 years later, I sold the property and made double my money. So I did the thing you're supposed to do with your profits. I went out and bought a truck and a motorcycle. Nobody taught me about reinvesting my profits.
Right.
I don't even think there was a 1031 back then. But anyway, that set me on a path. And so a couple of years later, I bought a house and I fixed it and flipped it. And then I bought the house across the street. And then that just sort of kept snowballing. Along the way, I had construction company, an insurance restoration company, and various other businesses. All of them were real estate and construction related. And also along the way, I continued to flip houses and buy small pieces of land and those kinds of properties. In 2014, I get a call from a friend and they say, "Would you like to buy a marina?" And I said no, because I had never bought a marina. I did not have a clue how to operate a marina. This marina had a campground with it, an RV park with it. But all of a sudden one day, and I had never owned a boat either. In fact, I still have never owned a boat. But all of a sudden one day I woke up and I had 115 boats. So after doing the evaluation and the analysis of this business plan and some people giving me some advice on how to monetize this thing, because I had a lot of business experience, then I went ahead and invested in it and bought it. And we took out the RVs. There were 23 RV spaces. We took those out. We built 38 tiny homes and we rented those out on Airbnb. We became an Airbnb superhost. And of course, then there was the marina, there was boat rental, boat storage, there was other storage, events, membership, etc. At one point, there were 13 streams of revenue on this one little piece of property. So that gave me the taste for multiple unit properties. And then the gentleman that I was in business with, where I was partners with, they then taught me about the multifamily space and apartments and how to syndicate and raise money and get those kinds of deals done. And then so since then, I've owned and operated or exited or transitioned through north of 1,200 doors.
Wow.
And so currently we're at 1,031. And that's been the path, that's been the history of where I sit today.
Yeah. So that's great timing. That kind of what you said earlier kind of reminds me of what my father says about me. So I was a great saver until I hit 16. And as soon as I was 16, I was no longer a good saver. But
There's too many temptations out there.
yeah. Yep. As soon as you get those wheels.
What's an odd thing is that my father, who was not a real estate guy, he was a construction guy. I mean, later he became, a real estate guy. But at the time that he gave me that advice, he said, go out and buy real estate. Just buy, doesn't matter what you buy, it'll be good. And I'm like, okay. So I found this little bitty pie-shaped piece of residential land in a cul-de-sac. I don't even think it was an eighth of an acre, and so that little piece of dirt started off this journey.
Did the person if it's so small, the person that bought it, did they just add it to their existing lot to have more space, or did somebody actually
It's
build on
separate
it?
houses built on it. Funny thing,
wow.
you say that. About 2 years ago, I got a wild hair, and I said, well, let me go back there and look at that piece of property. Because what I tried to do is I tried to track back through the through the Bexar County Appraisal District records to see if I could find my name on it, because I thought that'd be a nice piece of history. But this was in 1977, 78.
Wow.
So yeah, okay, that everybody's doing the math right now. And so those records were not available. But I did go back there. I took a little picture, and there's a little house, 2-story house on it, and there you go.
Yeah. You could buy it again for what, like 200,000 probably or more. Very cool. So you're in the syndication game now. How is that transition?
Yeah, that was a big transition. I'll be frank with you. That was a big transition because prior to, all of my businesses prior to that first marina, they were funded by myself, like no investors. And this is how I thought you funded a business. I'd always seen these big buildings out there and these apartments and these big complexes, and always wondered, okay, how are those acquired? And it wasn't until I was invited in on that deal that I understood how it was acquired. And so then that business model, that syndication, getting other investors in, paying them a return, having a done for you model for them, us being the operator, that made a lot of sense to me, because it made sense in that, okay, that's one way to get people in to invest. That's how you get those big deals. But it also made sense that it seemed to me like I was diversifying my liabilities, like I was spreading out my exposure. And so that gave me more opportunities to pull profits from a variety of sources. Even within one property, you have an opportunity to make money from multiple sources. And so just from a logical perspective, from a business perspective, that seemed to make a lot of sense to me. And so then we went down that path and learned the syndication, how syndication works, and all of those nuances there.
Now, how did you do that? How did you learn? What was it? Was it mentors, programs?
Definitely mentors.
Yeah.
So when I first obtained that property, we had to raise $1.4 million to close it. And I thought I could play iPhone Wheel of Fortune. So I thought I could go into my contacts and just go, all right, let me call him. Let me call her. And I actually did that. I'm like, I just started scrolling through all my contacts and the friends that I had through the years. And I was batting zero. I discovered later that the reason is because I was not known in that space.
Yeah.
I was known in other spaces. I was known quite well. I had good reputation in other spaces. But in the multi-family, multi-unit syndication space, I did not have a reputation, and I did not have any credibility. I didn't have a history. So then one of the partners came in, and he raised the $1.4 million in 9 days.
Mm-hmm.
And I'm like, wow, how did you do that? Well, he had an investor network. He had an investor database that he had been nurturing for a while. He had some history. He had a track record. And so since the property had, very good metrics on it, very good returns, it was a pretty simple ask for him to go out to his investor base and say, here's our next investment. Let's move forward with it. So that became the model that he and another gentleman that I partnered with, they began to teach me through mentorship. And actually, their mentorship was very hands-on. It was like experiential. It wasn't some, set of videos or that kind of thing. It was very hands-on and on the job mentoring, on the job training. And so then, in fact, I'm still partners with one of them now on a deal. So, and the other one, he remains a friend. So, I mean, these are all good relationships, the mentoring relationships. Yeah.
Yeah. And you didn't have to pay for that. That was just kind of because, you were sourcing deals and they wanted to kind of pay it forward to you.
That's right. They wanted to pay it forward, and and the reality is that I brought sweat equity to the deals. Also, I was, because of my strong construction background. Because of my extensive construction background, I was able to bring value to the deals, and so it was, it was symbiotic.
It's a win-win. Yeah.
Mm-hmm. Mm-hmm.
Yeah. So a lot of people run into like that, when they're first starting to swim upstream into larger deals and capital raising, they are known and they have their identity known as a certain thing. Like you were the construction guy, and maybe some people knew that you flipped houses and that sort of thing. So how did you go about changing that identity to Paul being a guy that has access to real estate opportunities that you can passively partner with? How did that process go?
Time. So time and numbers. So I had one deal. All right, that's one deal on my resume. So that made the next deal a bit easier, less resistance. And then once I had that deal, now I had 2 on my resume, and 3 and 4. So after time and plenty of acquisitions, partnerships, I actually only LP'd one deal. All the other ones I've GP'd. And so, and of course, now I'm the KP, I'm the guarantor, I'm the lead on all of our deals, because evolution of our business has taken us to that point. So what's next? What's next is, okay, the much bigger deals. So then I'll retool and I'll go, okay, how do I be a piece of those much bigger deals so that I can begin to add those to my resume? But I think if you're known in a space but not known in this space, you do have relationships that you can capitalize on, because there's always a trust factor there. There's a reliability factor. So it's now just the education and the conversation. Don't think that you have to have a whole new set of people in your tribe. The tribe that you did have, they just need to understand what you're doing next. And that's time, that's education, that's conversations. That's just getting with people and helping them understand.
Did you feel like you had to go full cycle to really put those on your resume, or once, the deal was inked and you guys were moving forward, that was a solid, hey, I've done this?
I did feel that I had to go full cycle.
Yeah. Okay.
I did feel like, okay, maybe I wouldn't have the amount of credibility that I thought I should have unless I actually had something provable that I could relate, or I could put it back out. And the truth is that didn't really need to happen, because if I could demonstrate, which we did, if we could demonstrate that the deals we were in were stabilized and that they were performing well, well, then that is a pretty good resume for the deals that you're trying to get. Would the proposition be stronger had I cycled earlier than I have? Of course, but that doesn't prevent one from asking. That doesn't prevent one from moving forward, and just being. Listen, if you're in the game, you're in the game.
Mm-hmm.
If you're in the space, if you're in the business, and you're serious about it, you're serious about it all the way through. So where you are in that journey is what you're dealing with at the moment.
What would you say to people that are coming in now in this much different market than when you started doing the syndications? What would you say to them? It might not be as easy, right, for them to get in and find these deals and to get really good returns and build this track record if we're in this weird market cycle.
I'd say this is the best time for them. because
Okay.
they're going to get a real picture of what real estate is like, a more real picture. If you came in the business in the last 5 years during the heat wave, great. You got a lot of experience and you got a lot of success. But a lot of those people weren't tested in the time that we're being tested right now.
Yeah.
So I've in my life, I've been through one recession and I ignored the other three. So the first recession that I went through was in the 80s, and I was a victim of that recession. I chose to participate in that recession. Oh, poor me. But the other recessions that have come along, I had a new understanding that was I don't have to be a participant in those recessions. So that's the same for people right now that are getting in this real estate market. You don't have to be subject to or a victim of the crowd mentality out there that could be on the negative side, because there are plenty of opportunities right now. And right now is the best time, I think, that we've seen in a very long time to learn how to structure deals, how to negotiate deals, how to do your asset management so that the deals perform, how to really build relationships. The people that we're building relationships with right now, it's like they're in this long term. We're seeing a whole new level of dedication in the people that we're networking with and dealing with now. Not that they weren't before. Okay, don't send me dirty, nasty emails. Okay, but the this is an ideal time to really help us know how to move forward with a great deal of experience.
What are the major differences between how you're structuring deals today versus how you were structuring them during that heat wave?
Yeah. So I would say the major differences are that we're really looking for verifiable, immediate income producing properties. So over the past 5 years, and I'm using that number kind of generically, you understand it could be a little more, a little less, depending on when when you started. But a lot of the pro formas and a lot of the business plans were based on what you could do in terms of improving the property. So, if you put in $5,000 into a door, it would yield X amount of extra rent. All right, that went to your NOI. All right, there's your business plan. But right now, I don't think we have the luxury of waiting and investing that $5, $6, $7,000, $10,000 per unit to yield an extra $75. So the deals that we're looking at, it's like, can we get that extra $75 right now? Because there's a loss to lease, and because the current seller, didn't maximize that for whatever reason. Okay, so and it doesn't have to be 75; it could be 35 without the rehabs. So what we're seeing on our properties right now that are performing well is that we're able to raise rent, we're able to bring it up to market, or even just a tad more without extensive renovations, just to freshen up, and then we put people in place. And because the rental market still is pretty good, like there's still people that are renting apartments pretty much, and rent growth is still decent. It's not 20% like it is like it was in some of the major metroplexes. It's single digit, but it's still fairly decent. So we're looking for those immediate bumps, as opposed to the bumps from a result of your capex. We'll do the capex, but that's further down the business plan.
Mhm.
Does that make sense?
Yeah. I was waiting to see if Matt wanted to jump in. I'll just follow that up with, like, how are you identifying that $35 to $75? I know when I'm purchasing something, I want to be pretty conservative. So I'm always thinking, like, whatever the sellers got those rents at, why would there be this extra $75 that they're leaving on the table? I kind of feel like I'd have to have a really good justification in my head to take that risk and say, yeah, I can pump these rents without doing anything other than taking over management, that much money.
It's a great question. I was just on a call coaching some people, and they asked me almost that very same question. So there's multiple levels to that answer. Here's the answer. Number one, you've got loss to lease just by doing your basic homework. You look at, and here's the track that we go through. What is the broker's OM? suggest? What does a co-star suggest? Secondly, what does apartments.com or apartmentlist.com suggest? And then what can we verify by doing our shopping in the market?
Mhm.
And so that's the path that we go down. So those first 2 or 3 levels will help us get to a point where we can provide or produce an LOI. And then when we're really, really serious about that LOI, now we'll go to those next 2 or 3 levels. Let's go do some shopping and let's verify that, yes, there are $35 or $40 in loss to lease. If we don't see that, we see a different number, well, then we'll underwrite to that number. And so we go through a pretty extensive verification process there.
Okay. What does your
We also,
cycle look like?
I mean, this is another thing. We also communicate with and consult with the property management company that is helping us acquire that property or that's going to manage that property. So, at the end of the day, they're the ones that's going to have to execute the business plan. We'll manage them, we'll monitor them, but they're the ones going to have to ask for that extra rent. So let's see what they think about it as well. So there's a bunch of levels to verify that.
Okay. Has full cycle changed at all, in this market versus the heat wave? Are you still 3, 5, 7 years, or have things kind of shifted in your mind
It's
as
longer.
far as how long is longer?
Well, our average full cycle previous to the heat wave was 33 months.
Mm-hmm.
Even though all business plans were 5 to 7 years, the average disposition was 33 months. So now what we're seeing is, okay, it's probably going to be the 5 to 7 years. And so we're anticipating that ride for 5 to 7 years because interest rates are still an unknown. The future of interest rates are still unknown. There's some uncertainty in the economy. My biggest indicator is always consumer confidence. How do consumers overall at large feel about the condition of the economy? And so right now, consumer confidence is a little dicey. So there's a trickle down from that uncertainty. And so we'll let the market level itself out. We'll let consumer confidence gain. We'll let all the indicators of the market stabilize and get stronger. And then we'll start taking a look at disposing of some of our properties.
Gotcha.
One additional thought, if I may, back to your question about the rents. Sometimes a seller will just leave some enchilada on the Mexican plate for us, right? On the Mexican platter, they're going to leave an enchilada for us, and we're going to take advantage of that. That's my meat on the bone analogy.
So you kind of see that some of the units are maybe leased up at 1,000, maybe 70% of them are at 1,000. Same size units are leased up at 900, and maybe he hasn't raised those people for some reason.
They got a lot out of their business plan, and they're like, we really want to sell this, so let's leave a little bit for the next operator to entice them. That's not an uncommon strategy.
Okay.
Yeah.
So Paul, getting back to the 7-year term, do you get pushback from investors on that? Because, I talk to some investors and sometimes 5 years is long-term for them, which is completely antithesis to way that I think, 20, 30 years is a long time, not 5 to 7 years. So when you're pushing out that 7-year term, kind of how does that dialogue go with that potential investment partner?
From the right investors, we don't get pushback. There are a group of investors that they want their returns in 12, 24, 36 months. Okay, so right now, this may not be the vehicle, and that's fine. There are other vehicles, right? So we go through a fairly extensive interview process, and we like to know our investors, and we like to know what their expectations are for returns and time and performance. And if there's a fit, great. We'd love to have you come in and be an investing partner. And I think maybe that's partly a mindset, because we feel like we add great value to the market. Like we have something of value for investors, but it's not for every investor. So just like oil and gas is not for every investor, or stocks, or you name it, there's the way that we've structured our investments and the term and the returns and the done for you model and the personal touch that we add. All of that is for a certain group of investors And listen, there's 8 billion people in the world. We will find those investors.
Yeah.
So follow-up question to that is on the longer terms, that sort of thing. It sounds like you go through a discovery process with your potential investment partners. So what's the kind of the order of operations in that discovery to find out if they're a good fit?
So we like to find out if they have any real estate experience or business acumen. So in reverse order, if they have business acumen, they understand cycles of business, they understand personnel, they understand P&Ls, and they understand spreadsheets of, of financials. So they have an understanding of business itself. Okay. Do they have business acumen? Secondly, do they have real estate investing experience? Because if they have real estate investing experience, they know about the cycles and they know what asset classes have remained fairly stable over the past 15 to 20 years. And they have an understanding of how to evaluate an asset class and evaluate a real estate deal. So that is, and we've discovered that our avatar, like the primary person that invests with us, is a business professional. And so they're investing for depreciation, they're investing for tax advantages, usually first over returns, because they have that need, they have that requirement. And so business acumen and real estate experience. And then beyond that, well, then we, start filtering through other things like, are they accredited, not accredited? Are they a referral? Did they just hear that? Did they just hear that we know what we're doing? That sort of thing, right?
Yeah.
So,
do you jump out of the multifamily space and do anything in industrial or storage or anything like that?
yes. So we have purchased a piece of land on the south side of San Antonio. And on this land, we're building a brand new self-storage development, 450 units, about half climate, half non-climate. And we've already done the demolition on the structures that were there. And so we are applying for a permit. We hope to put a shovel in the ground in the next 3 months. And that's a 1-year build. It's in a very rapidly growing sector of San Antonio. So we're happy about that. We initially were contacted about this piece of land thinking that we might build apartments on it. So we went out there, we did some feasibility, we did some evaluation, and we discovered that apartments really wasn't the play, that self-storage was the need out there. And so then we went through the process of taking down the land, going through the engineering, the architecture, the preliminary meetings with the city of San Antonio, all of that. And so here we are. And we're just like super excited about that. Remember, I told you I have a very strong construction background and very extensive building background. So I hadn't built anything new in quite a while because I'd been buying existing apartments and so forth and renovating those. So when this surfaced and I got a chance to do new development from the ground up, it was pretty exciting. And now having been through the process, it just continues to be exciting. It's about a 1-year build. It'll take about 33 months to stabilize from the time that it's complete. So this is 4 to 5 years of building in front of us.
Yeah. Well, that's a cool pivot. What about the build to rent space? Are you excited about that and maybe pursuing some of that?
We look at those. We do look at those properties. I do not have any of those at this moment, but we are actively looking at those. We have some other people that have come to us and asked us to partner on those. So we're evaluating those. I think it's the place to be. Two things. I think build for rent, and I think flex space. So I think those are the next 2 things on the frontier that will really make a difference in the real estate industry and for investors, and actually be absorbed quite quickly. So the absorption rate is a key indicator when you're in those kind of new products like that. So multifamily, listen, people are still always going to need a place to live. It's going to be there. I don't ever see it changing or not changing for a very long time. I don't know what the current statistic is, but the last statistic I looked at, this country has a shortage of 4 million doors for places to live. So there's ample opportunity there. Secondly, for whatever reason, people are going to need a place to store all their junk, me included. So you know, we see that as an ongoing asset class. And then because of the cost of housing and because of the cost of mortgage borrowing, build for rent seems to make a lot of sense going forward in the future, at least for the next 10 years, I think.
Yeah. What would your build to rent look like? Would it be like townhouses, or how would you plan your community?
I would plan my community one of two ways: either the townhouses, but more of an upgraded community that with townhouses, some amenities and so forth. And then the second way is if I just wanted cash flow and just wanted a place for people to live, I would do duplexes, and I would make it look like a community. I would have very few amenities. I don't see the need for a big clubhouse and a big wave pool and those kinds of things. I just see 1,400 square foot properties, houses for people to live in, and then the community is, it comes together because of that.
Yeah, affordability.
Yeah,
for sure.
affordability. Mm-hmm.
What markets do you think are best if you're going to explore that build to rent space? Would you still be in Texas for that?
Yes. And that goes to a bigger question. It's like, where is our country moving? Mm-hmm. So our country is moving to the South for a variety of reasons: weather, economics, taxes, politics, quality of life, etc. So the southern region of our country, Arizona, Texas, Oklahoma, Alabama, Florida, to Georgia, that whole Carolinas. So that whole southern region there seems to continue to make sense in terms of population growth, in terms of companies moving to those areas for a variety of reasons: population, tax structure, quality of life, weather. They're all interrelated.
Yep.
Less government interference. All of those things are all related.
You want to jump in, Matt?
Yeah, on the locations. Well, actually, let me back up a little bit. Have you ever done any apartment ground up apartment construction?
I've never built ground up apartments.
Okay, yeah. So I was going to ask you, Mark and I are from a kind of a Rust Belt city in the Northeast, right? Rochester, New York. And we have a housing shortage as well. But the thing is that with construction prices have gone up so much, and ground up, or even just like adaptive reuse rehab, that we're having a hard time having ground up construction pencil out, because the price per square foot is so high. The last job that I had priced out was like $250 a foot. And when you have the rents that we do, it's difficult to do that. So are you seeing that in your markets that more of those types of projects make sense from a financial standpoint, given the the state of price of labor and materials and stuff like that?
I think you have to be. I think you have to be organized to be able to do those ground ups. Like, that has to be in your wheelhouse. If it's in your wheelhouse and you can get it done economically, cost effectively, then I think, yeah, sure. Why wouldn't you build a new product if you can withstand, the carrying costs for the next 24 months to 36 months? Why wouldn't you? Because now you have an asset, especially if you want to have a legacy asset, because now you have an asset that for the next 20 to 25 years is going to need very little care.
Yeah.
Because it's a new product. So from that side of it, it makes sense. From the side that we're on, it's like we don't want to really do that carrying cost and wait that amount of time. And we'll buy existing product. We'll find a good deal on existing product. We'll make the existing product work and go from there. The difference in the development is there are carrying costs on that property. Believe me, there's a lot of interest carry and soft costs that we've already put out on our own, out of our own pocket. So there are a lot of carrying costs, but we think the upside is going to make it worth it. And we think that the other thing is we still have 2.5 acres left over after we build this. So when this works, we can now do a phase 2.
Mm-hmm.
So we left ourselves that option there. But yeah, if you're a builder of apartments, new product, and it works for you, I understand that it's hard to pencil out right now, but if you can make it pencil out, that's the way to go, I think. I would imagine too that you're dealing with government regulation that is not helpful and friendly to you, permitting, inspections, those kinds of things, environmental maybe, but probably your biggest obstacle right now is just the cost of materials and labor.
Mm-hmm.
Yeah, for sure.
Yeah. And that's not uncommon in most areas of the country.
Right.
The cost to do business, build those is very rich right now.
So on the subject of talking about costs here, what's your capital stacks typically using on from a percentage of debt to equity on the deals that you have been doing over the past, let's say 12 months?
Okay. So I hope I'm going to answer your question correctly. So typically our deals are 70-30 LPGP.
Mm-hmm.
We're seeing in the range of, we're seeing low 60s in terms of leverage.
Mm-hmm.
Let's see, I guess the last 3 deals that we did, they were around 62% leverage. So that was okay. I mean, you like better, but that was okay.
Mm-hmm.
It wasn't offensive. That was okay. And then, so we usually do a pref, some sort of pref on the thing. We'll do an equity raise with a pref. And right now our deals are projecting in the high teens on the annual rate of return, maybe even 20 on some of them.
Mm-hmm.
Wow.
So I think that's anyway, that's what we look for. So I think that's pretty common. It's pretty average, but that's what we look for. Anything less than that, we don't take it. We don't take the deal.
And it's low 60s in terms of LTV. Is that because of the cost of the property and maintaining a debt service coverage ratio on those deals as to why those are relatively low leverage? Because the good thing about Rochester is that we can find a lot of deals that we can lever up between 75 to 80% loan to value,
and still come in above on 1.25.
Mm-hmm.
Yeah, that's the balance there. So you're 1.25 or less, they're gonna lever you up or lever you down really to get to the 1.25. So anything more than 1.25, they're gonna lever you up. Yeah.
So here, I gotta change gears a little bit. Matt and I are both big on thought leadership, and I noticed that you are planning a summit. Is this your first a summit that you're going to do? And maybe just talk a little bit about how you got into that and what the whole process looked like.
Oh, good. Thanks for asking about that.
Yeah.
I appreciate it. Yeah. So, so during the pandemic, I sat here at this desk in front of this computer every Tuesday morning at 9 a.m. and mentored a group of about 23 to 25 people every Tuesday for an hour and worked with them through the course of the week. And right before that, my wife and I were holding events, and we were getting a pretty nice bit of traction. So then we decided that after the pandemic, after we were all released from prison, that shall we make political comments now? After all, we were all turned loose, that we would hold live events because we just saw the value in it. We like those. We've invested well over $100,000 in the last 12 months ourselves in masterminds and conferences and those kinds of things. So, and we see the tremendous value there. So then we said, okay, what's different and what's unique and what will really be helpful to people? So we put together this summit. It's in Scottsdale, Arizona. It's in October, on October 18 through 22. It's at a private residence. It's a group of private residences, actually. And there's master en-suites. And so everyone will be in this facility. There's swimming pools. There's 3 swimming pools. We're having private chefs come in. We're having yoga instructor and meditation guidance in the morning. And then through the course of the day, we're going to be covering a whole day will be on multifamily. Another day will be on alternate sources of real estate asset cash flow, like BFR, like storage, like flex. And then the next day will be on branding and capital raising. Okay. So we're making it a very intimate event, a very close event to network. We discovered that what we appreciate and where we got more value out of is when we had a lot of time to actually sit with people, talk about our businesses, work on our businesses, plan. And so we're also going to go through a process of developing a 12-month business plan for everyone that attends. And then we will do a 6-month weekly follow-up with everyone to help make sure that they are staying on track so that they can accomplish their business plan. I've been through programs where this accountability piece is just so valuable. And so we're going to offer that. We offer that out to everyone that comes to our event in terms of the accountability. In addition, anybody that has any kind of challenges with the deal will be available to answer those. Anyone wants to partner with the deal, if the deal makes sense, will be available for that. They need a sponsor on the deal, we'd be available for that. They need capital raising help, we'd be available for that. So not only it's a collaboration, but it's a movement going forward with a group of people to do business together. And the other thing that's different about this is the tuition or the fee is all inclusive: food, room, drinks, entertainment, adventure, training, all of that. So,
that sounds amazing.
Yeah, we're super excited about it because we feel like it's just unique enough to be attractive. And the key piece is the follow-up and the mentoring. We discovered that, man, we really like that mentoring, and it's a strange thing. You don't want to feel like you're not qualified to do it because you don't have like 10,000 doors or something. But listen, I've been through, like I said, 1,500 doors. I got a lot of experience. I've been in the trenches with lenders and syndicators and property management and asset managers, all of that. And I think it's fair to share that information. Somebody shared it with me.
Yeah.
So I think it's only fair.
And how many spots do you have at that event? Is it pretty limited?
We have 10 remaining. We have a total of 40. We have 10 remaining as of last night. Yeah.
So you said 40 total?
40 total. Mm-hmm.
Okay. Wow.
Yeah.
Well, you heard it here,
so
guys. You better get that ticket.
So Neil Bawa is a friend of mine. You may know who Neil Bawa is. And so he's going to come be with us for a day. He's going to tell us about his whole BFR strategy. He's also going to help us through our goals, and he's going to help us workshop, our plan. And so the guy is, I know he likes to call himself the nerd or whatever he calls himself, but he's extremely
the mad scientist.
Yeah, mad scientist. He's extremely savvy, extremely insightful. He's very thoughtful of what he's doing, very methodical about what he's doing. So we're really looking forward to having him. We'll have a cost segregation expert there. We'll have a capital raising expert there. So we feel like we've got all the bases covered.
Yeah.
And it's going to be a really great event. And it'll be in a casual atmosphere where we can really relax and network and collaborate and get to know each other and build relationships.
Perfect. And what's the site people can go to sign up for that?
Adventurers Summit. No, back up. AdventurersInvestmentSummit.com.
Cool. I will put that in the notes.
AdventurersInvestmentSummit.com. Yeah.
Awesome.
Anybody have a question about it, they obviously can reach out to me. We'll answer their questions.
Very cool.
I can see the wheels turning on Mark. He's like, I'm gonna check my calendar, man. I'd be in if I didn't have a 4-day-year-old baby.
Right.
4 days?
Yeah.
Wow.
Yeah.
Your life has changed now. Do you have any other children?
Yeah, we got a 3-year-old. We got a 3-year-old.
3-year-old. Yeah.
So yeah.
So five places where your life changes. When they're born, when they walk, when they hit puberty, when they learn to drive, and when they leave. Everything else is just filler.
Yeah.
But the other thing that we've done is we've incentivized teams to come. So we have a couple of teams that have already joined the summit. So again, the big push behind this is so that people can collaborate and work together and move together as a team. Our team was going to be there. And so we've got a couple of teams. So if you're out there and you're listening and you think that this would benefit your team, I mean, this is ideal. And like we will work together with you as a team.
Yeah. And I love the accountability piece. That's golden.
Huge.
Are you going to have one group? So everybody, all 40 people, or are you going to kind of break it down into like, oh, okay, you guys are similar experience level. We'll put you into an accountability group, or is it kind of everybody all at once?
We're going to start with one group because we feel like we will have built a lot of synergy together in Scottsdale. If it pans out that we need to give a more personalized approach to other people, we'll do that. No challenge there. At the end of the game, I want you to be able to say, yeah, they really helped. The Montelongos really helped. Like we are where we are today because we got some real insights and they took care of us. And that's very, very important to us. Fortunately, my wife and I are at a place in our life where, okay, we're in the give back phase. Yeah. Right. So we've been very fortunate to have really good careers and be to where we are now. And we just continue to see the value of mentoring and giving back. And it's very fulfilling.
Yeah, that's amazing.
So Paul, on the subject of Torchbearer, do you raise capital on a deal by deal basis, or do you raise capital via fund?
So Torchbearer is my property investment company. Like when I make an offer, it's made in that company name. Of course, it's always assigned over to the buying entity. But we've recently rebranded to Montelongo Capital for that very reason. It will become the fund. We're going through the process right now of developing the fund so that we can do fund to fund transactions, not only to our deals but to other deals. And so that is the next level for us. It's been building to this point, and we finally embraced it. And so over the next 12 months, that will be one of our focuses so that we can acquire more assets.
And what will be the target type of assets in terms of the policy portfolio for that fund that you have in your mind?
I see it to be the same as what we're used to and what we're familiar with, the multifamily and storage, cash flowing, equity building type properties. Yeah.
Okay, so those will be your guide rails then, because I know the one thing I want to touch on before the top of the hour is you've been involved in some real estate asset classes that are a little scary to some people, like the marinas and hospitality and that sort of thing. So I'd love to hear more about that. I'd like to hear more about that because that's a space where I've seen deals that have come up that have been, small, motels or hotels, and that's just completely outside of my, wheelhouse, so to speak.
Right. When I first started in the business, I would look at all those assets, all those asset classes, because I was interested in multi-unit, multi-check diversification of liability, right, of exposure. As it turned out, I started focusing on multifamily. It's like, it's the old saying, man who chases two rabbits catches neither one. So I just focused on multifamily. So now that we have a lot of traction in multifamily, it made sense to move over to self-storage. I'm not opposed at looking at those other classes because we have a great deal of experience to be able to look at those other classes. But I think the power of focus is very, very, very important. And so when you can stay focused on a certain asset class, a certain track, I think you're going to get better results. So we'll more than likely stay focused on those classes that we're familiar with. And having said that, we could very easily come across some partners that are say, let's say they're experts in RV parks. Okay, well, I owned an RV park, but that was one. But let's say they've owned many, 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 and so they're experts, and they're looking to collaborate with someone who can bring capital or bring some sort of experience. That would make sense. So we would be open to those kinds of opportunities. But I think for the most part, we're going to stick to what we know for a while.
Yeah,
I've
just
got
to
a
kind of
good
get.
question. Oh, go ahead, Matt.
Oh yeah, I speak on the focus. I mean, I kind of think about this a lot, and this is a little bit philosophical, but when you think about kind of what separates humans from the animals, it's focus and collaboration. I think are like two of the key differences. And yeah, focus is that fulcrum of that lever that if you got focus, then you can have leverage to move to move great things.
Mhm.
So yeah, no, I'm there, and that's why I haven't veered off of that path. But yeah, I mean, Mark, I've looked at deals before. I'm like, oh man, Monopoly world, right? It's like
Mhm.
building a hotel. Like that's like that's definitely one of those things that just seems very, very sexy. But I always have to like humble myself and think and keep, being like, okay, I just gotta stick with what I know where my track record is. So
Right.
Yeah.
But I like that you have that kind of a thought process and you have that kind of vision, because that could be in your future.
Mhm.
You could be the next Hilton if you wanted, right? Conrad Hilton. There you are.
Yeah.
We do, you win.
So I've
Um,
got one more that'll probably eat up a little bit of time. So you've been doing this for a long time. I'm curious as to how you've built your team over the years. Specifically people on your payroll, your personnel. I'm sure you have key people. So maybe talk a little bit about what that looks like, how it developed over time, and then your key differences between people that you have that you keep on as W-2 employees, and then what do you outsource as far as subcontractors.
so most everything we do is outsourced. Okay, we just have a few people in-house, but most everything we do is outsourced. And that's because we don't need them 40 hours a week. We need them for project related instances. Okay, so having said that, I think the key to hiring people, and by the way, in my career, I've hired over 1,000 people. I've had over 1,000 people work for me, and plus vendors and subcontractors and 1099ers and those kinds of professionals. I think the key thing here is to get to know who you're working with, and do they share the same values, and do they share your same current values? Because my values as a younger man were different than my values as an experienced man. So um, do they share the same values? And that just takes time. That takes time. That takes experience. One of the best partners that we have is I'll tell he'll be nameless for right now, but we've been in the foxhole together, trying to get deals, trying to save deals, trying to make deals work. And it's when you're in that situation with someone and you get to really see their level of tenacity and their level of creativity and their dedication to what they're doing, that to me is extremely appealing. I like to think of myself as having those qualities. And so when I see someone that has those similar qualities, that's a person I can work with. And so
Yeah.
that takes time. That takes time and experience. The first level is, do you like them? Like, do you like them? The second level is, are they competent in what they do? And then the third level is, okay, what's going to be our experience together? And that
Mhm.
just takes time. And so that time sometimes is a few months, and sometimes it's a few years. And at this moment, that's my vetting process. I don't
Yeah.
have any fancy Wonderlic test that people go through. It's just my gut, the experience. You will find out a lot about someone if you just listen.
Yeah.
If you just listen to what they say, their words, their actions, who their associates are, how their children behave, all of those kinds of things indicate what kind of person is across the table from you. And so I pay attention
Yeah.
to a lot of those things. I hope people pay attention to those things in me. And
Mhm.
because I think I would like to think that my life is congruent, and I like to work with people whose lives I think are congruent. Does that make sense?
Yeah. So as like a KPGP syndicator, do you find like you really don't have a need for payroll? You can pretty much outsource everything, or are you still going to have a couple key personnel that really help you with the day-to-day operations and maybe take some stuff off your plate?
Yes, we still need in-house people, W-2 people. So one of the things that we're doing now that relates to this is we're going through an organizational restructure. So we're working with a coach to help us put in CEO, COO, and then the various levels along the chain here, the organizational chart, so that we can continue to grow. That takes time. We have allocated a year for that process, to go through that process so that we can grow the next level of our business, more acquisitions, more management. Little by little, we're going more vertical. So we probably in the next 24 months, we will be virtually 100% vertical. So that's a process. Yeah.
Yeah, I'm sure we could talk about that for about an hour. So love to have you back on after you get through that process. I
Sure.
started a property management company years ago now, and so I feel like I was just kind of vertically integrated by nature of what I was doing previously, which is nice. So I like to hear the people that embrace it, why they embrace it, and like how they made that transition, because it's not easy to bring that component in house.
No, it's not appearing to be easy. I think our mentality right now is not so much money as it is control. And I mean control in a good way, in that we're able to manage the parts and pieces more closely and more effectively, and we're able to pivot more quickly by having these internal departments and these internal meetings.
Yeah.
That seems
And I
to be
find
the advantage to it right now.
Yeah. I always find it eliminates people being able to point the finger at other vendors. When you use a lot of vendors, one vendor's like, oh, it's that guy, and you're just chasing around in a circle. Like, okay, he said it was you, you said it was him. Somebody
Yeah.
screwed up.
Yeah.
But when it's your problem and it's your wheelhouse, you can really sort that out, because there's got to be accountability.
Right. Yeah. So we're really excited about the future. We think the future holds a lot of good things for the industry, and we think the future holds a lot of good things for us as a company.
Yeah. Any final thoughts? We got a couple minutes before the top of the hour.
Well,
yeah, go ahead. Go ahead, Matt.
Oh, yeah, Paul. So in terms of vertical integration, are you talking about property management is the next step you're going to go, or are you already there?
Yes. Property management, we're halfway there. So property we're already asset management inside. So property management, and I would say we're probably 75% construction services and construction management inside. Nice. So we see property management, and then we see some of the other verticals, like maybe title and maybe insurance, and some of those, maybe some of our vendor services, plumbing, AC, etc. So we're looking at those opportunities as well.
Yeah, I mean, Mark and I both, we both have property management companies. I happen to our management company only manages our own assets. And the reason why that was important to me is that, in an age where everything has become so, virtual, you can't even call a company and get, speak to anybody anymore. You're dealing with some sort of AI and that type of thing. In the property management industry, we have such an immense amount of power to create the customer experience. And I think that's where the area where, because self-managing does not save you money, but it does allow you to have more control over the customer experience. And because we have such a large exposure to multifamily, retention is absolutely key. So we can, prevent somebody from making the decision to, let's say, buy a house, which is the number one reason why we lose residents in this market, because it's so convenient to live with us. And so, the customer experience is so great, then we can really add that as a profit center on keeping that retention up.
Absolutely.
Makes total sense. And I think we're on the same page there. Makes total sense.
Yeah. Yeah. We hit a lot of things here at the end that is like almost another hour's episode worth. So you guys will have to come back on when Paul joins us again, and we'll dig into the nitty gritty. But we're at the top of the hour, so I will sign off. Thanks, everybody. We'll drop information in the show notes so you can come to Scottsdale and be a part of that amazing community. And we'll see you guys next week.
Appreciate it. Have a great one.